Hello and welcome to the first ever video on the Millennial Investing Channel. I thought in my first video there was no better place to start than to do a complete run through of my current portfolio. I started this portfolio a couple of months ago now, probably like a lot of people did when the market crashed, and gradually moved quite a lot of my savings out of my savings and into the stock market to try and take advantage of some of those low prices. So my plan is to sort of document the journey of this portfolio, share my thoughts on stocks and trends, and hopefully give some people out there some ideas and to bounce ideas off each other, which can only be a good thing. So the current form of this portfolio is, being 2 months old, is pretty close to what it was when I first started it. I have made a few tweaks over the last 6 weeks from stocks that I decided didn't quite fit in with what I wanted to achieve, whether because they weren't either fitting a sort of capital appreciation model or a dividend growth model. The aim of this portfolio is to try and strike a balance between the two. So to dive straight in, as you can see, what are we now? Approximately 2.5 months into this, 10 weeks. We're already up 17, nearly 18%, which is over £1,500. So a fantastic start. Largely down to luck. I managed to sort of time the bottom on some stocks pretty well, which have seen a pretty strong bounce back. So yeah, let's dive straight in. So first on the list, 3i Infrastructure is actually the newest stock in my portfolio. This was purchased yesterday. Probably not a particularly well-known one. They are a company who basically invest in infrastructure projects in developed markets, with a focus on renewable waste and sustainable companies and all that sort of thing. So really interesting company to get into. It says here, invest in various sectors such as transport, power utilities, energy and healthcare. Invest in energy from waste plants and that sort of stuff. So really quite exciting company. On a fantastic growth trend, as you can see from the chart. Dips have bounced back pretty well, albeit not to the heights they were at. I wish I had got into this stock a little bit earlier, but what's my average price? 274. Isn't too bad. Especially when you consider the PE ratio is still under 10.5, which is pretty damn good. If you're interested, I would definitely recommend you have a look at the 3i Infrastructure website. You can go into their portfolio, and it'll give you a run through all the bits they do have investments in. So first one here, Netherlands utility company. They own 2 energy from waste plants, so creating energy from sustainable sources or waste. That's not going to go anywhere. So with the growing market, really exciting company. The next one, Infinis. Anyway, you get the idea. Have a look at that. So back into the app. So the big draw of 3i Infrastructure for me was not just that I think it's at a reasonable price right now, it's also because it's got a healthy dividend yield, 3.36%, in addition to the fact, really strong capital appreciation, as you can see from the chart. If you go on their website, they do say that their strategy is to maintain a balanced portfolio of investments to deliver an attractive mix of income yield and capital appreciation to shareholders. So those two facts tied in with the fact I like the business model, I like that they're investing in sustainable businesses for the future, makes this a really attractive stock for me. Moving down the list, Alibaba, I'm sure a lot of you will know, largely billed as the Chinese or the Asian Amazon. They are an e-commerce company. Another one which I wish I'd got in a little bit cheaper, although it didn't drop too much in the recent correction, the ongoing America-China trade war. is holding this back. I think this has got plenty of room to run. If you look at the PE ratio on this, 22, just under 23, and you compare that to Amazon, a similar company, probably the most comparable company, Amazon's PE ratio is currently 106. So if you consider they've got similar growth prospects, we look at the growth. And here, Amazon's growth is predicted at 67. That's quite high actually for the next 5 years. Alibaba's growth is predicted at 48, so slightly below, but not massively so. And that difference in PE ratio is pretty significant. So if you're looking for a stock to hold longer term, this is definitely a good option. Moving on, Alphabet, one of my favourites, slightly down today, but again, fantastic chart. Obviously, Alphabet own Google and YouTube, two companies which I don't think are going anywhere anytime soon. It's got a sensible PE, really good upward trends, good profit margins. Debt to assets only 27% and holding significant amount of cash, 120 billion cash on the balance sheet there, which is huge. Really safe bet for sort of longer term growth. Same with Amazon. I think Amazon is going to take over the world at one point. They seem to be in every market going and expanding at huge rates. You saw the growth rate a minute ago. So already up 22% in this. You can see how quickly the bottom was. So from, where was it, February there down to March. Bottoms in, what's that, March the 11th? And within a week it was already back up where I managed to get in. It's just sub 2,000, so not a bad price, especially given where it's ran to so far, but maybe not quite as low as it could have been. Again, well, PE is slightly high. The growth is so big that it's sort of factored into pricing. Really good balance sheet, loads of cash on there again, and again you're buying this one for growth. They're only going to go one way. Apple, another one of my sort of core holdings, had a really good run of late as well. Managed to catch that one pretty close to the bottom, up 25%. PE ratio is sensible, sub 27, which for a growth stock is pretty good. Does pay a dividend as well, which they're growing annually. So longer term, this could start to yield a pretty healthy dividend if it carries on the way it's going. Great balance sheet, and really good income statement as well. Now into my banks. So I do own 4 banks. So Bank of America, Bank of Montreal, Barclays, and JP Morgan's a bit further down there. So I've got a split between the UK and Barclays, obviously in America with Bank of and JP Morgan, and then Canada with the Bank of Montreal. The Bank of Montreal, fantastic dividend, 6.25%. I think it was close to 7% when I bought it, because I did get it pretty cheap. Been paying their dividend consistently. I don't think they missed a payment in something like 30 years, maybe longer. So great buy. I think banks in Canada are sort of the biggest companies out there. Really, regarded as really safe. So quite happy with that. Again, Bank of America managed to get pretty cheap, really close to the bottom. Hasn't bounced up, interestingly, as much as the UK banks, which I think Barclays is up 30-40% now. So it hasn't come off that bottom quite as aggressively as Barclays, but still seeing some good bounce back. And the banks, actually, compared to a lot of the other sectors, haven't recovered as quickly. There's still some good value in there. Bank of Montreal, obviously, and then Barclays. Managed to get in really good price, 87 pence a share. Wish I'd bought more of this one, to be honest. P ratio only 5, although in honesty the best way to value a bank, in my opinion, is to look at its price to book ratio, which is basically its assets on its balance sheet, what it's valued at on paper. If all went wrong, what is left in that business that they could sell off. And at the moment, Barclays is still ridiculously cheap, 0.31 with fair value being 1, i.e. the share price equals the paper value of the company. So at the moment it's 31%, or say 69% less than that value. So incredibly cheap if you look at it from that perspective. So quite happy with my banks. Had some decent initial gains. I think they've still got long to run, and obviously receiving dividend yields from these as well. 6% and a bit from Bank of Montreal, slightly less Bank of America and Barclays, and then JP Morgan, I think, is about 4%. Then moving into some of my sort of consumer staples, consumer discretionary buys. So Coca-Cola, I thought I got a pretty good price, but it really hasn't recovered much at all. It did drop below $40 a share. I got it about, 45. It was probably overvalued at these sort of levels, and I think it'll be a long time before it gets back up there. It'll probably, I think, get above $50 pretty quickly, but how far it runs after that, I don't know. Sensible PE and a good dividend yield, 3.5%. So this is one that definitely falls into the dividend category. Comcast. The reason I bought this was because they bought out Sky. Big fan of Sky. Think it's a great product. Again, I don't see that going anywhere. Sensible PE and dividend yield. Dark Group. Now this is one which sort of breaks the mould of my portfolio, which is ordinarily to buy really safe, sensible businesses which have very little risk attached to them, and hopefully buy them at decent prices. Dark Group is an airline. It's basically Jet2. Dark Group are the owner of Jet2, so a northern airline who have been growing really, really well over the last sort of 5 years. Always sort of score really highly in customer service and all that sort of thing. I use them regularly myself. I think they're a great company, so that was why I sort of initially took an interest. If you then look at their balance sheet, their cash and short-term investments 1.27 billion, and they have no short-term debt, and their long-term debt is only 1 billion. So they actually hold more cash than they have long-term debt, which for an airline is phenomenal, really. So that sort of made my mind up that I was going to buy into Dark Group, and it's done really, really well for me. I think my best performing stock so far. We're up nearly 60%, 70 shares, and I think this will keep on going. And I think in time it will get to where it was, which is significantly above the level it is now. So we'll hopefully see a really healthy profit on this one. Facebook, my second best performer. Again, fantastic stock. It's flown off the bottom. I got it really, really well timed on this one. Similar to sort of the Apples and the Amazons, the Googles. This is one that I consider a core stock in the portfolio. Don't plan on selling at any point. Then into a couple more speculative stocks. So Illumina. So these guys are. This is a bit more of a spec play, really. They are a genetic sequencing company who are growing really, really well. We've got some new technology coming out, and they're sort of making some pretty big breakthroughs in the DNA sequencing model. They're bringing the cost down of DNA sequencing significantly, and they're starting to make some noises about potentially being able to cure diseases before they actually happen, i.e. enter people's DNA, edit out dodgy piece of DNA to stop problems occurring in the future, which would be absolutely incredible if they could do that. And obviously we're sending the stock price absolutely rocketing. Whether that happens or not, I don't know, but for one share, I thought it was worth a place in the portfolio. InMode's another one. This one has done phenomenally well. I bought this probably last week, I think it was, late last week. Already at nearly 12%. These guys do sort of cosmetic surgeries, minimally invasive cosmetic surgeries. So probably things like lip fillers and facelifts and all that sort of stuff. I would consider them a growth stock. So to have a PE of 18% is is low in my opinion. Great growth, look at that growth, grown phenomenally well. Profit margin of 40%, which is huge, and a really good balance sheet, and debt to assets only 17%. So great financials, probably a market which is only growing, rightly or wrongly. So that is in there for growth. So fingers crossed that grows even more. I can see that one doubling within the course of the year. S&P 500 is fairly self-explanatory. Johnson & Johnson, you'll notice I only hold £2.33 of this. The reason being I'm desperate to buy Johnson & Johnson, but it's just too expensive right now. But I put it in my portfolio to remind me every day that I need to buy it at some point. So I've got a reminder set for 140. I'd like it to get probably low to mid 130s before I do actually buy into this. Great company, but just too expensive at the moment. McDonald's falls into my consumer staples discretionary along with Coke. Again, hasn't bounced back quite as much as I was hoping, but in there for more of a dividend play, 2.68%. And hopefully that'll grow as well. Again, McDonald's not going anywhere. Microsoft, another one which I would consider core. I didn't catch the bottom, so I didn't buy in as much as I would have liked. Great company. $1.838 trillion market cap, which is huge, and definitely a stock I will be looking to increase my position in. For growth stock, half growth stock, it's probably run a long way. 38p, maybe slightly high for me. Now getting into some Reits. So I do like my Reits. I do know the property industry well. I do work in it. For me, the best place to put your money with regards to Reits, and I will do a separate video on this, is in Reits which focus on industrial property. So Segro, sort of a south-west based company, I think they're based in Slough. They focus primarily on industrial property, which is the growing sector. And so property offices are starting to struggle. A lot of people working from home. Retail has taken a bit of a nosedive. Lots of tenants not paying their rents there. Industrial, along with healthcare, probably are the two sectors that I'm investing in with my Reits. So Segro up 18%. Good dividend yield, 2.5%, and also a really low payout ratio of 26, so that's got a lot of room to grow. Alongside Segro, Tritax Big Box REIT, so these guys only own big distribution, big sheds with sort of institutional spec tenants, so the supermarkets and the 3PLs and all those sort of guys. So really solid outfit, again up 25%. I would value Reits the same way I value banks, so a price to book valuation. Sub one at the moment, so still relatively cheap, even though they have bounced off the bottom pretty well, and are getting up towards all-time highs. That still got a long way to go. Dividend yield just sub 5%, in my opinion, is a great buy. The other REIT I own is Amiga Healthcare Investors. This is an American company. I did want to own a healthcare REIT. I was looking at a couple of UK REITs, Primary Healthcare Prop and Azura, both of which just look too expensive to me. So I decided to go for this one, primarily because its yield is so attractive. It's got such a high yield. Yes, its payout ratio is high, but I decided to take a bit of a risk on this one, just because the others were too expensive. This was cheap and had a great yield, so I went for this one. Square, another one of my sort of spec stocks, has done well since I bought it. Hopefully this will take off at some point. They're really starting to gain some traction. Growing really well. Balance sheet is good. Sort of breaking into a new market with loaning small businesses money, which is where there's quite a lot of growth in that business. So fingers crossed we've got room in that one. Tesla is probably the biggest regret in my portfolio. I saw it go down. Where did I see it? About 500. I didn't buy. I wish I bought, but we're in it. 737. I think I was originally in about 650, maybe 600, but I averaged out when it kept rising. Averaged up even. I still think this will go higher. I do think this will easily get over $1,000 a share within the next 6 months, but for some reason I'm reluctant to buy, just in case it drops off again. But at some point I will have to buy back in and increase my position here, because I do think long term it's going to go a long way, just because of obviously the electric car market is, it's the only way things are going, and they are well at the forefront of that. In addition to that, they've got their energy business, so their batteries and their solar panels, which is also going to grow phenomenally, I'm sure. So people think they're just a car company, but they're not. They're an energy company as well. Unilever is a new sort of consumer staple stock, similar to Johnson & Johnson, another one I wanted to own, but I thought it was a little bit expensive. I have bought a small amount. Another solid company, great dividend, not going anywhere, so quite happy with that one, and will add to my position if it starts to dip again. And then I have my ETF, so I am in the FTSE 100, although I'm not particularly overly enamoured by it, and I will do a video on why that is. I just think it's too service and energy heavy, especially the energy sector. Oil and gas companies are only going one way, as shown by Shell recently, and a lot of people are reliant on that dividend, which is collapsing. This is probably my favourite ETF. For those that I've noticed, I don't have an awful lot of consumer discretionary stocks in my portfolio and high yielding stocks. This is where I try to balance that out. So the Vanguard FTSE 100 All World High Dividend Yield. If you go on the website, you'll see this has 1,710 stocks in it, which is huge. Sensible price to earnings ratio, sensible book to back, price to book ratio, well diversified in terms of geography and sector, a little bit heavy in financials. And here is the distribution, or the weightings of each company in it. You'll notice Johnson & Johnson has the highest percentage at just 2.243%. And I think as you get onto the second and third page, you'll notice all these companies have less than 1%. Look at this. AbbVie, 0.68%. HSBC, 0.59%. It's so well diversified. All these companies have got such a small share in it. The distribution yields is, I think, 4%. Yeah, 4.09. You do pay management charge on that, so you're probably just shy of 4%. So that is where I try and get my dividend from. I am going to try and bulk up this holding as opposed to buying individual dividend stocks. And just to finish, Visa, the financial stock, with payments going online, I can only see this going up in the short term. Did manage to get it pretty cheap again, so quite happy with that one, and hopefully they grow that dividend. So that is all for my portfolio and the first video on this channel, so thank you very much for subscribing. Would love to hear your thoughts on any of the stocks in my portfolio, whether you think they are rubbish choices, good choices, and why. Please comment below. Please like and subscribe if you enjoyed. Thank you very much.